Today we would like to review European GDP data as well as Chinese manufacturing data. Good morning. Today it is Tuesday the 30th of April. I'm Matt Henderson and I'm one of the portfolio managers here at True Potential. Now, as mentioned in the introduction, we've got two main things to focus on in today's video: Europe's GDP data and Chinese manufacturing PMIs. So starting closer to home with Europe's GDP data, we've had the release so far this morning of Spanish as well as French GDP data. Later on today, we'll receive German, Italian and Europe as an aggregate level GDP data. So what have we seen so far this morning? Well, both France and Spain's GDP numbers have come in higher than what markets had been expecting. France, that came in at 0.2% relative to the expectation of 0.1%. Spain, that came in at 0.7 versus the expectation of 0.4. Now, the hope is that these data prints will continue when we see Germany and Italian GDP, meaning that Europe will escape from the technical recession that it saw last year. Now, why did Europe enter into that technical recession? Well, there's three main things: high inflation rates, higher interest rate policy coming through from the European Central Bank, and weaker GDP data on a global basis, and those dragged Europe into that technical recession. If we move over into the second half of the video and focus on Chinese manufacturing PMI data, what have we saw there? Well, it's a similar theme to what we've spoke about in these videos before, where we're seeing that rebound in manufacturing sectors within economies. So the data came in at 50.4%. And the way that these indices work is that any reading greater than 50 signals expansion, any below signals contraction. So it's the first time in a year that we've seen back-to-back readings from Chinese manufacturing greater than that 50, indicating expansion. And that's mainly coming through the new orders component. Now, why is that useful for China? Well, we still know that the domestic economy is weak. None of these numbers within Chinese manufacturing have been driven by the domestic side of things. It's more coming from the global economy rather than on Chinese shores. We know that China have a 5% GDP target for the year, so policymakers will be hoping that that strength that we're seeing within the manufacturing sector can continue to help them deliver that 5% policy target rate. Thank you for watching today's video, and we'll catch you in tomorrow's episode.